And X autos still very strong, up 6/10, up 6/10. Well, in comparison,
I want to stop it here. And the main point I want to deal with on this is the fact that retail sales rose 0.7%. Now, why this is important is, once again, something that is a positive is being considered a negative, which makes absolutely no sense. The fact that retail sales is up, the fact that the consumer is still spending is not a negative thing, especially when inflation continues to come down. Now, what it is affecting at the moment on a short-term basis is interest rates are continuing to go up, which is causing a problem in the stock market on a short-term basis. I want you to remember this. This is short-term. This is not a long-term thing. It's not going to continue to go up forever. But the fact that the retail sales went up is not a negative thing long-term. It means that the consumer is still holding together.
Has been poring over the Fed Beige Book. Let's get to him now for the details. Steve, what are we learning?
For like speed reading, Kelly, rather than poring over it. Little to no change in economic activity in the Beige Book, the collection of economic anecdotes from the 12 Federal Reserve Bank districts. Consumer spending said to be mixed. Tourism improved, but some districts reporting a slowing in consumer travel and yet an uptick in business travel in a few districts. There was a modest decline in loan demand at banks. Delinquency rates were still set to be historically low, yet they were.
Now, what I want to focus on this one is what he was talking about is that delinquency rates are still historically low. Now, I understand we've gone up in total debt on the credit cards. Not disagreeing. We also have more people. So keep that in mind. The delinquency rates are continuing to still stay low. And we're continuing to see tourism improving. Again, none of this is a negative thing. And the interesting part of this is that you're seeing the economy continue to go, even though everyone is telling us that it's not. So I find it rather interesting what they're talking about here.
Slightly increasing at this point. Multiple districts report improving outlook in the manufacturing sector. And I'll just pause here to say that anecdotes may take on more added importance because it seems like more and more Fed officials are relying on anecdotes rather than the data. Data's been so strong, but it seems like the anecdotes, as witnessed in this Beige Book, seem to be a bit weaker than the strong data. The outlook for the economy is generally stable or slightly weaker. Holiday shopping outlook was said to be mixed. On to the important sectors of labor and prices. First, labor. The labor market continues to ease with improvements in hiring and retention. That's good news. Less pushback from candidates on wage offers, but employers continue to have to modify those contracts to offset higher labor costs, including offering things like work at home and lower signing bonuses. Prices increased at a modest pace. The input costs increase have slowed or stabilized. Again, good inflation news. Input costs are still rising, however, for services.
Labor not going up too fast, still going up, still moving in the proper direction. Everything is perfect here. This is exactly what the Fed wants to see. Now, again, I'm not saying this isn't going to be necessarily a negative thing when it comes to interest rates, and that's where it's actually running the stock market right now, or interest rates rather than actual business. But, what do I know?
Something the Fed has been watching carefully, and sales prices are increasing at a slower rate than input prices. That's a margin compression story right there. Businesses are struggling to pass those costs along, as you can see. Now, firms expect price increases to slow or to come in at a slow rate in the next several quarters. Kelly, I'll leave it there, but just want to emphasize, you guys like Barkin, even Waller out there talking like, you know what, the data seems strong, but our outlook is really for the economy to slow down. And that's a lot based on the anecdotes they've been hearing from different business contexts of theirs.
All right. So with Steve, just net this out for us. Any change you would glean from this, or officials might glean as they try to figure out whether we need, for instance, another rate hike, maybe in the next couple of weeks, or maybe just before the end of the year?
No, it's like, you got the whites in the washing machine. Now let's throw the stripes into the just put it into the hopper there as another piece of data that's out there. And remember, I think the operative phrase, I think what we're going to hear tomorrow from Powell is a message of patience. So this goes in there, and now we wait to see, does the data begin to reflect the slowdown that we seem to be hearing in the anecdotes? Because
so what they're really saying here is the rhetoric actually going to match what the numbers are? Because right now, none of it's matching. Everyone is saying this is what's happening, but when you look at reality and you look at what's actually happening, that's not what's happening. So again, don't focus on this and put your portfolio based upon this, because we're talking few short days. The question really becomes, what does this do long term? None of what he's talking about here, none of the retail sales, none of the stuff that's actually happened in the last couple of days, as far as the data that's come out, is going to change what the Fed's going to do. Fed's going to do what's going to do. What's going to help, if there's anything that's going to help, which I think they've already made up their mind, but that's beside the point. If something is going to help, the fact that the interest rates are continuing to go up on the long end, that's where the bigger issue is. And my concern on the market, not concern, but what I think is going on in the market at the moment is this.
Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the true state of stocks with earnings, interest rates, and the war in the Middle East impacting sentiment. Markets are on the move. The investment committee is here to guide you through all of that. Joining me for the hour today, Bryn Talkington, Joe Terranova, Jim Lebenthal, Steve Weiss. Told you the markets are on the move. The market, there you go. Stocks are down and rates are up. There's the 10-year, 491. Joe, to me, that's really the biggest story to talk about. You had two things to keep your eyes on really over the last, now you move forward here, earnings and rates. Earnings have...
So anyone who's questioning why the market's down today, this is it right here. The fact that the 10-year is at 4.9%, first time since July of 07. Now, again, everyone's trying to make these correlations to what happened in 07 and 08 to what's going on right now. And again, only time's going to tell on that number. But please explain to me, if you really think that's what's going to happen, what's that catalyst? What do we have out there that is going to cause an 07 and 08, Great Recession again? So I'm not in that camp. I'm also not in the camp that interest rates are going to be anything but a short-term uptick.
For the most part, rates are not going in the right direction, though.
100%. To a certain extent, you're watching oil a little bit, but
Yeah, oil's up.
it's about 10-year, and it's about the 10-year approaching 5%. 30-year above 5%. And this is a challenge. This is a problem. We know what's coming on November 1st with the Treasury announcing what their supply is going to be. I've said yesterday, I don't like the premise that the Federal Reserve is going to continue to do rates because the bond market is doing the work for the Federal Reserve. So collectively, what's the impact on the market? I'll tell you this from someone who is bullish on the ability for the fourth quarter to be positive, driven by the Magnificent Seven. Today's an ugly reversal. Today is not a day for the bulls. Today is a day for the bears. This is not a pretty reversal. And the only thing keeping the market from deteriorating further is Apple, Alphabet, and Microsoft. They are providing a degree of resiliency from the market moving even lower.
Well, we're going to get into really what's at stake. We got Netflix and Tesla after the bell, too. So you got a good test for the NAS. I mean, Apple right now is negative. A lot of, Microsoft and Alphabet are barely positive. Jimmy, I'll go to you because you are a representation of the bullish perspective. So you got rates. It almost feels like that 5% of the 10 years formality at this point, that it's going to get there. Not that far. What are we, 8 basis points away?
Yeah, it's pretty close. Look, that's certainly an issue. I'm not sure that that's the issue facing the day today. I hear you, Joe. I actually think that it's the Middle East. I mean, that news from yesterday about the hospital was jarring to everybody. And I think the markets have been on edge for several days.
Wouldn't yields be lower?
What's that? Wouldn't yields be lower for the Middle East? I'll come right back to it. I got you. All right. I hear you on it. All right. But I think the equity markets right now, I think they're a little bit on edge on what Iran's saying, which, by the way, you don't sell on every time Iran rattles the swords. You'd have no money at this point in time. I think that's what got the equity markets on edge. To your point, though, this is a question in terms of the yields of what's the more powerful force, declining inflation or increasing deficits? Right now, it sounds like increasing deficit. I don't think that's going to last, and here's why. If you look at that last CPI report, and this is courtesy of Ed Yardeni, our mutual friend, if you strip out shelter, which we know is lagging, both the core and the headline goes at 2%, which is right where the Fed wants it. And we know that shelter's lagging, so I think it's going to continue to come down. That takes a lot of pressure off of the Fed, and that's one force that would counter back.
Okay, so what I want to focus on here is exactly what he's trying to say. All the stuff that the Fed's trying to do is being handled. We know shelter, and you see my other videos on this. Shelter is all of it. It's 40% of the core. It's 7.2%. The rest of it's at 2%. So all we have to do is get shelter down to where we want it to be, and it will be there. And I've got a video coming out on this in the next couple of days that you'll actually see where I'm coming from on that. And my issue, I want to make sure everybody's doing this stuff in giving examples and not just giving rhetoric, okay? So in my mind, what he's explaining here is exactly right. The market's freaking out a little bit because of the tensions in the Middle East. And we've talked about this, that unless there's a major escalation, I don't see the Middle East being a problem. But we're hearing rhetoric, we're hearing things out of the Middle East that's riling the market. And their concern is that it's going to get larger. And if it does get larger, it's going to be a problem. There is no question about that. So what Jim's talking about and what I'm talking about are exactly the same thing. Yes, the interest rates are an issue, but the interest rates were up yesterday and the market was, so, it didn't totally sell off. Today, it's kind of gone crazy, but so something more, in my opinion, had to happen besides interest rates going up. And it's the tensions in the Middle East. So assuming the tensions in the Middle East kind of abate at some point here, and, interest rates are not going to go up forever. The rest of the stuff is already handled by Powell. Powell is going to be in very good shape here. He is not going to have to raise. The market's doing exactly what he needs it to do. Interest rates, all he has to do is be patient. We've talked about this. The rest of the stuff just has to stay in line. And again, not that he's not going to keep interest rates where they're at. He's not cutting anytime soon, but he doesn't need to raise. The market will figure this out. And just like the two people on here were talking about before, I really think the fourth quarter is going to be a positive thing, but it doesn't matter what I think. You and me, I like to deal with reality. And the reality is the market's selling off today, but it's selling off for today for something that is probably not a long-term situation. So we'll wait and see what happens with Tesla and Netflix this afternoon, and then we'll go into Apple and Microsoft and all the other earnings that are coming up in the coming weeks. And, make sure your portfolio is set up for this. But again, make sure it's set up for the long term. Don't deal with these short-term issues. These are short-term problems. They shouldn't be long-term issues. If they become long-term issues because of the tension in the Middle East, we can adapt. But at the moment, make sure your portfolio is set up for your long-term needs, not what's going on in the market on a short-term basis. Dickie out.